Hi, and welcome to the Money Tips No One Told You podcast, presented by First Pioneers Federal Credit Union. Here at First Pioneers, we're passionate about helping not only our members, but our community become financially successful. That success often starts with basic knowledge, things like knowing how different account types work, to understanding terminology, or even tips that make your life easier. The more you know, the more success you will have as you handle your money and your finances. Let's get started. Hi, I'm your host, Heather, with First Pioneers Federal Credit Union, and I'm actually really excited about today's episode because we're going to talk about credit. And I know what you're thinking. Credit is not exciting, but I think this may be the thing I get asked about the most. Young people I know, they want to establish credit. Older people want to make their credit better. So today, I want to explain these things as well as what makes up your credit score. So let's talk about it. Let's start with establishing credit. You actually have several options. One we recommend and offer at our credit union is a series of credit builder loans. At First Pioneers, you begin with a 6-month loan for $250. Then once you've paid that one off, you move on to a $500 loan, again for 6 months. Next, you move to a $750 12-month loan. And then your final loan is $1,000, and that one is for 12 months as well. During this time, you want to make your payments on time and keep these loans in good standing. And at the end of the 3-year period, you will have established a good credit score. Now, many financial institutions offer something like this. It just may be structured a little differently at different places, but it's definitely worth looking into. Another way to establish credit is by opening a secured credit card or loan. With most installment credit accounts, the item you're purchasing is the collateral against the loan. It secures the loan. But with this type of credit, you secure the loan or the credit card with money that's in a savings account at the financial institution that's issuing the credit. Let me stop for a second and talk about why collateral is important. And, this is the not so positive, not so fun thing to talk about. But sometimes life or other things happen and you're just simply unable to pay a loan you've agreed to. For instance, on a car. Let's say you stop paying your loan for some reason. That's called defaulting on the loan. At that point, the lender can repossess the collateral, in this case, the car. But I want to make something absolutely clear here. No financial institution or really any lender wants that to happen. In fact, it's been my experience, particularly with a credit union, that we will work with you as much as we can for as long as we can so that this doesn't happen. But it is an unfortunate reality at times. Now, we're going to talk about defaulting more in depth in another episode. It's kind of not as cut and dry as people think, but just know that it's not something that we expect to happen or want to happen. So thanks for coming to my TED Talk. Now back to the secured credit. The money you set aside for collateral will be held in an account until your loan or credit card is paid off. You aren't able to access that money as long as it's needed for the loan, but as you pay the loan off, the amount you've paid can become available to you for your use. Some people also use a cosigner for credit to help them get started. In this instance, someone with established, hopefully good, credit signs with you for the loan. You're sort of using their credit score, so it will most likely need to be maybe a family member or a good friend, as this is a pretty big responsibility. If something happens and you default on the loan, then the cosigner will be responsible for the loan. Otherwise, it could actually negatively impact their credit as well. For example, this can be a great option for parents and their kids as they build their credit, especially as they move out on their own. Things like apartment leases, cell phone agreements, or even turning on utilities need credit to do so. This is called service credit, and it's actually something not many people think about being part of their credit score, but it definitely counts. A parent or family member may consider co-signing in an instance like this to help their child get established. Just make sure you take it seriously and understand the agreement before you sign it. The thing you're working towards here is a good credit score, which you'll find on a credit report. There are 3 credit reporting agencies: Equifax, Experian, and TransUnion. A lender will pull a credit report from all 3 agencies to see if you're a good risk for the credit you're applying for. Now, your score is going to vary a little bit by agency because each credit bureau places a different emphasis on different things. Your lender will most likely look at the score from each agency and then take the one in the middle. Now let's talk about what makes up your credit score. Number 1, payment history, which is 35% of your score. Number 2, the amounts that you owe. That's 30%. Number 3, your length of credit history. That's 15%. Number 4 is new credit, which is 10%. And then number 5 is credit mix, which is also 10%. Let me see if I can break these down for you. As I hope you heard just then, payments are a big part of your score, 35%, the biggest part of it. So if you take nothing else away from our talk today, take this: pay your bills on time. It matters to your score. Another big one is how much you owe. Let's say you have 3 credit cards with a $10,000 limit on each. That gives you available credit of $30,000. The rule of thumb by most lenders is to not use more than 30% of that credit. So for this example, try to keep what you're using under $9,000 or $10,000. Otherwise, lenders start to wonder if you're a good risk if you owe a lot and are using all your credit. Third is length of credit history. If you've had credit for a long period of time, then a lender can look back and see your patterns and your habits. Of course, for younger people just starting out, this is going to take some time, but it should get better as time goes by. Fourth is new lines of credit. Opening new lines of credit are a hit on your credit. I'm going to explain that more in just a minute. But for now, let's say you want to take out a loan for a car or to buy a house. Try not to take out several new lines of credit at once around that time. That can hurt your score for the loan you're trying to get. But it's only for about 6 months, so just keep that in mind. If you've had some new lines of credit recently, maybe just let some time pass before you do more, especially those big ones like the car or the house. Lastly is credit mix, and that's just like it sounds. It's the different types of credit you have. There's revolving, which is credit cards. Installment loans are things you've agreed to pay back at a specific amount each month. That's things like a car or a mortgage. Another is the service credit we talked about earlier. Probably the most well-known service credit is a cell phone contract. So the 3 reporting agencies look at these things and a few others from your credit report and give you a credit score. And you can get your credit report from annualcreditreport.com. They offer a free report once a year from all three of the reporting agencies. You can also purchase just your credit score from FICO. That's FICO. And you can find both of those online. Now, scores range from 350 to 850. Most lenders consider 720 or above a good score. I think it's important to state that when you go into a loan or a line of credit agreement, you do it in good faith that you'll repay it. And generally, that's what happens. The lender goes into this agreement with a certain amount of risk. This is why a credit score is so important. They measure the risk of what they're willing to lend based on that score. If you're considered a higher risk, you'll most likely pay a higher interest rate. Because let's face it, we said it before, sometimes things happen and a loan can't be repaid. The lower the score, the higher your interest rate will likely be. On the other side of that, the higher your score, the lower your interest rate will likely be. So, what does that mean? Once you've established a good credit score, you want to at least maintain it, or if you can, make it better. Now, we've been focused on the score, and like we said, that is very important. However, there are other things showing up on your report that can affect it. Missing payments can drop your score as much as 60%, and that remains on your credit report for 2 years. Maxed out credit cards can reduce your score 100 points. Closing credit cards can actually reduce your score as well. I know a lot of us think, oh, I've paid it off, let me close it. But what this does is it reduces the amount of available credit. You remember when we talked about that earlier, the amount you have available versus the amount that you're using. So leaving those accounts open, especially if you're applying for a new loan like a car or mortgage, can actually be helpful. Multiple inquiries on your credit can lower your score as well. I said I would get back to this. There are what's called soft hits and hard hits when it comes to checking your credit. Let's say you get a credit card offer in the mail. That's what's called a soft hit. It's not something you actually applied for, so it won't affect your score. A hard hit is when you actually are applying for lines of credit. For instance, if you're car shopping, it'll be evident that that's what you're doing. So if a lender sees more than one hit on your credit in that short period of time, they're going to take that into account. But don't just apply everywhere for lots of different credit cards and things like that. So that way those hard hits won't happen. Just apply places where you really think you want to use their loan or credit. Opening multiple new credit cards or loans can also have an impact. I think we said that before, but especially loans that are less than 6 months old. Also, having a higher balance on your credit cards than installment loans can actually make your score lower. See, credit cards are revolving credit with no collateral, so they're considered a higher risk to the lender. If you have any bankruptcies, they remain part of your credit history for 10 years. Judgments remain on your credit report until they expire, unless the creditor reaffirms the debt, then it stays till it's paid. If you have any liens or collections, those will show up and they can make a difference in whether you get approved for a loan and on your interest rate. And when we say collections, think of any bills that you owe that maybe have been sent to collections. I find that's often a medical bill. One other thing to consider, I've been hearing a lot about people taking student loans, then basically living off of them. So using them as income. Something to realize is student loans never leave your credit, even if you default on that loan. Where other liens may eventually leave your report, a student loan, however, is with you forever. Just something to keep in mind. It's probably better to look for another source of income versus using a student loan. Did you know 50% of credit reports contain errors? With that in mind, it's a good idea to review your credit report about once a year. If you have any collections or judgments, you can set up payments and take care of those. You can also dispute anything that's not accurate. Some really common errors are things like previous employers or addresses, as well as judgments or collections that were actually paid off, but they're still showing up. If you do find an error on the report, you can actually send a letter to the credit bureaus and to the lender disputing the information. You want to include copies of any documents that you have to support your claim, but keep the originals for yourself. You only want to send copies. You always want to keep those documents in your records just in case you need them again. Now, the credit bureau is required to investigate within 30 days and to give you the results in writing. How many of you have run into trouble or challenges and your credit score just needs some work? And maybe you're thinking, I really don't know how to make that better. Well, many of the things we've been talking about today can actually help you. Let's start with that payment history. It's on your report for 2 years, which means you can work to make it a better history. And those old habits will basically start to go away and not be reported anymore. And that will help your score. So start making your payments on time. If you need to, sign up for bill pay or something like that. That can help you be on time with those payments. Your financial institution should offer some service like that, and they should be able to help you set it up. Now, if you have liens or judgments or collections, make arrangements to pay them. Get those taken care of, and then they can be removed from your report as well. As always, if you need help, speak to your financial institution for guidance. They may be able to help you when you're writing letters to creditors and things like that. You can also build your credit score through those credit builder loans or secured line of credit that we talked about earlier. And using the cosigner, that's another one that could help as well. Any or all of these could help bring your credit score back up. Also keep in mind that a score, it's not all that a lender will look at. Showing stable employment can make a difference. Even the amount of money you have in savings or investment accounts can demonstrate that you have the means and the ability to pay your loans. So don't get completely hung up on that score. Your habits have a bearing as well. This is often when a credit union can be an advantage. Many big banks just simply don't have the ability to sit down and talk with you and help you as much, and their rules may be too strict to loan to you, where often a credit union has financial counselors on staff. They can sit with you, look at your finances, look at your challenges, and give you some guidance, and perhaps even be able to lend to you where others can't. So I always recommend build a relationship with your financial institution. It can really help. One more thing I want to share. You may hear a lender talk about debt to income ratio. This is something else that they look at. So what is debt to income ratio? It's when you compare how much you owe each month to how much you earn. It's basically the percentage of your gross monthly income, which that means before taxes, that goes towards payments for rent, mortgage, credit cards, or any other debt that you have. So what is an ideal debt to income ratio, you ask? Well, lenders generally prefer a debt to income of 36% or lower, and you want no more than 28% of that debt going towards a mortgage or rent. So 36% or lower is the number that you're shooting for. If yours is high, consider looking at what your debts are and trying to reduce those, especially if an increase in income is not really an option. Look, less debt is always better, not just when you're applying for a loan, but for your life and for your budget. I've seen people pay scary high interest rates just to get a loan because either they had no credit or they had bad credit and they felt like they had no other choice, particularly for cars. So they end up paying so much more than they should have. My recommendation, look at your situation and see what you can do to make some improvements. It is possible to make this better. And I truly, truly hope that some of these tips we've given today can help you get to a better place with your credit or help you build the credit you need to achieve all the things you want in life. Just don't give up. Ask for help. Solutions can always be found. So before we go today, join us for our Employee Spotlight segment. It's here at First Pioneers. We're family and we want you guys to get to know ours. So today I have Jeff joining me. Welcome, Jeff. Thanks for being here. And why don't
Thank
you
you for having me.
yourself to the listeners?
Hi, everyone. My name is Jeff Fontenot. I am VP of Lending here at First Pioneers. I have been here a total of 14 years. 5 of those years have been over here physically at First Pioneers. The prior 9 years was at Heritage Credit Union, which was a credit union that we merged in 2017. And I was one of the employees that came over with the merger.
Awesome. So let's jump into our questions because we want everyone to get to know you a little bit. So Jeff, how do you define success?
So I define success as how much of a difference you can make in somebody's life rather than define it by material items. And I think my job here at the credit union allows me to be able to do that every day.
That's great. The thing we love is helping people, right? So who is your inspiration?
So my inspiration has always been my dad. And although I lost him at a young age, he always taught me to work hard, be a good father, keep a good moral compass, and never forget where you come from.
That's great advice. Okay, so lastly, what's something on your bucket list?
So something that's always been on my bucket list was to travel more to the Midwest area, like the Yellowstone area and all that Wyoming, Montana area. And I think watching the show just kind of made me want to visit that area even more.
It's very beautiful, isn't it? I think a lot of us would love to go out there. So thanks so much for being here today, Jeff. We've really enjoyed visiting with you. And join us next time for another Spotlight. Thanks so much. Thank you so much for joining us today. You've just watched our YouTube version of our Money Tips No One Told You podcast. There is also a blog version on our website at firstpioneers.com. You can always find us at any of our branches in Lafayette or New Iberia, Louisiana, on our website or on any of our socials. We're here to help you in any way that we can, and we really appreciate you watching. See you next time.